We talk SPACs every morning. I heard a phrase I'd never heard before recently. It used to be you'd have a beauty pageant or an auction, which I know you'd run an auction for a company. Now they have SPAC offs, right? You have a target company and everybody shows up as a SPAC. What's happening here?
Well, they fulfill kind of a unique space, and I don't think they're going away. You know, what's happened over time is that the technology around them has just gotten better. Most notably, frankly, around doing these pipes into SPACs. But I think what's happened with SPACs is they become just a unique vehicle for certain companies. Right now, because of the public equity markets are so high, you can actually get more from a sale of certain companies through a SPAC than you can in the private market. There's actually a disconnect between the public market and the private market. If the overall capital markets weren't as high as they were, SPACs would not be as active. The other thing, too, is that, yeah.
No, well, Rob, I think you're pointing up a question. I often get email that I'm a SPAC hater. I'm not a SPAC hater. I'm a questioner of the valuations in the SPAC universe, in large part because SPACs have been driven up by retail investors, and you just pointed to the issue, which is in the SPAC land. In the public land, the valuations are much higher. The private markets don't want to pay those kind of rates. What does that say about the valuations of where we are?
Well, I think you have to look at how these SPACs come about and why the technology has gotten better, and it has a lot to do with these pipes coming in, which is where you basically have sophisticated institutional investors doing the due diligence on these acquisitions and coming in and buying common. This is not preferred that these
common institutions stock, just so we're clear, right?
They're buying. That's right. The so-called pipe investors are buying common. One way to look at this, Andrew, is to look at it almost as if this is public venture capital. Because what you can do with SPACs, what you can't do with IPOs, is you can go to these sophisticated investors, you can show them projections of a company that otherwise might not be ready to go public. And I think the retail investors in SPACs are relying on the very sophisticated investors to buy these pipes. Now, I'm not, suggesting that SPACs are going to be a huge percentage of the M&A market, but I think for the M&A business, it's just another way of monetizing. You either sell to a strategic, where you can get synergies, but there could be regulatory issues, or you sell to a sponsor. That's certainly possible. But here, this is just another. For us, it's great because it's another potential buy.
And a sponsor being a private equity firm. Let me ask you this. There's been lots of speculation about whether big companies that want to spin out a unit will start to look at SPACs as a potential buyer, if you will. But there's a lot of complications with that because you actually not only have to spin out the unit or you have to break out the information. The way SPACs work is investors that are invested in the SPAC are brought over the wall, if you will, and they get temporarily blocked from doing anything, and it makes it complicated given the amount of time it may take to do the diligence. Do you see that as an opportunity in the future or no?
I think it's unlikely because most of these particularly larger corporations, the entities that they're going to spin off are large enough or mature enough that you can just spin them off and the public market will accept them. These are unique circumstances, SPACs, where it's a complicated story that you need to tell. So it's possible, but I think the number of deals that are done, spin-offs that are done through SPACs are going to be minimal, if any.
Shepard Smith here. Thanks for watching CNBC on YouTube.